The story does not begin with silver. It never does. It begins with belief, with confidence quietly leaking out of a system long before the price reacts. Markets move last. Psychology moves first, somewhere between a boardroom in Shanghai and a vault that did not receive its expected shipment. A decision was made that looks irrational only if you believe prices are facts rather than opinions enforced by leverage. A Chinese billionaire does not bet against silver because he dislikes metal. He does it because he understands structure. He understands that paper markets reward those who arrive early to the exit and punish those who assume liquidity is permanent. Silver is not traded like copper or oil. It trades like a memory of money that never quite died. That makes it dangerous, not volatile. Dangerous. For decades, silver has lived in a suspended state. Officially an industrial input, unofficially a monetary metal treated by policymakers as an inconvenience from another era. This ambiguity allowed it to be suppressed without being buried. Futures contracts multiplied faster than ounces could be delivered. Leasing replaced ownership. Promises replaced possession. The system worked because it relied on a simple assumption. Most participants would never ask for the metal itself. History shows this pattern repeating whenever a monetary asset is allowed to trade as if it were infinite. The moment physical withdrawal accelerates, the paper market must either reprice or fracture. That is not theory. It is a recurring stress response. Gold has lived through it. Currencies collapse through it. Silver has been flirting with it for years. The billionaire's wager is not against silver's long-term value. It is against timing, against public conviction, against the ability of the market to stay irrational longer than inventories can stay hidden. Betting against silver at this moment is not a statement of disbelief. It is a provocation. Because silver is not just a commodity to the West, it is a strategic vulnerability. It sits at the intersection of defense, energy transition, electronics, and monetary trust. When a non-Western capital center openly challenges its price structure, it is not merely a trade. It is a message. That is where politics enters the frame. Donald Trump does not fight back because he cares about silver as an investment. He fights back because silver represents something older than finance. It represents sovereignty over value. His worldview, shaped by tariffs, trade wars, and industrial revival, sees markets not as neutral arenas, but as weapons. A market that allows strategic materials to be controlled through offshore leverage is, in that worldview, a national security failure. The conflict is not personal, it is systemic. On one side, capital that understands how to exploit paper dominance before it collapses. On the other, a political movement that distrusts abstraction and prefers tangible control. Silver sits between them like a fault line. The Chinese billionaire's bet assumes that Western markets will defend the illusion a little longer, that regulators will prioritize stability over truth, that margin requirements, contract rollovers, and opaque inventory reports can extend the performance. He may even assume that political noise will distract from structural stress. Trump's resistance assumes the opposite. It assumes that allowing strategic metals to remain artificially cheap undermines domestic production and exposes the nation to external leverage. It assumes that breaking the spell, even violently, is preferable to slow decay. This is not the first time power has collided with price. When empires sense decline, they do not argue with charts. They change rules. They impose tariffs, they investigate exchanges, they reclassify assets. History is full of moments where markets discovered that they were not as free as they believed. Silver is particularly sensitive to this because it is small enough to move and symbolic enough to matter. A modest shift in physical demand overwhelms the entire paper structure. A small loss of confidence turns hedging into hoarding. When that happens, shorts do not lose gradually, they lose suddenly. The public rarely sees this coming because the price screen remains calm until it is not. Analysts argue about technical levels while vaults empty quietly. By the time headlines appear, the move has already occurred in the physical world. This creates the illusion of a sudden event, when in reality it is the final act of a long ignored process. The billionaire understands this. His bet is not reckless, it is precise. He's wagering that the fracture point has not yet arrived, that political intervention will be delayed, that faith in paper settlement will hold just long enough for him to exit. Trump understands it too, from the opposite angle. His fight is about forcing recognition, about dragging a suppressed reality into the open before the cost becomes uncontrollable. In his framework, confrontation now is cheaper than surrender later. What makes this moment dangerous is not silver itself. It is the alignment of stress across systems. Debt levels are elevated, trust in institutions is thin, supply chains are brittle. In such environments, symbolic assets become accelerants. Silver carries history. It carries memory. It reminds markets of a time when value could not be printed. That memory is inconvenient. When a Chinese billionaire bets against silver, he is not dismissing that memory. He is testing how long it can be ignored. When Trump pushes back, he is not predicting price. He is rejecting the premise that value should be outsourced to leveraged promises. Eventually, one of them will be wrong. not because of intelligence or information, but because timing is unforgiving. Markets do not care who is right. They care who runs out of margin, who loses patience, who blinks first. When silver finally resolves its identity crisis, it will not ask permission. It never has. It will simply move, and the explanations will follow after the damage is done. Silver is not being traded as a metal in the conventional sense of supply meeting demand through honest exchange. It is traded as a psychological instrument, a test of collective belief rather than physical reality. Its quoted price does not emerge from the weight of bars moving between hands, but from expectations layered on top of expectations, reinforced by leverage and sustained by the quiet agreement that delivery will never truly be required. The market functions not because silver is abundant, but because faith is. Paper dominance survives only under one fragile condition, that the majority of participants accept substitution, contracts instead of coins, cash settlement instead of metal, exposure instead of ownership. This arrangement did not arise by accident. It emerged because it was efficient for institutions, profitable for intermediaries, and comfortable for participants who preferred liquidity to responsibility. As long as silver could be treated as an abstract position rather than a tangible asset, the system rewarded speed over substance and scale over scarcity. The psychology at work is subtle. Most traders do not consciously believe silver is infinite. They simply behave as if it is. Screens update instantly. Orders clear without friction. Vaults remain out of sight. This distance between action and consequence creates a mental buffer where risk feels theoretical. In that space, leverage thrives. When risk feels remote, it can be multiplied without fear. But every paper market that disconnects from physical reality carries an unspoken assumption that demand for delivery will remain marginal. The system is calibrated not for truth, but for averages. It can withstand noise, speculation, even periodic stress. What it cannot withstand is a shift in intent. The moment participants stop treating silver as a trading vehicle and start treating it as something to possess, the entire structure begins to strain. This is why every major bet against silver at moments of rising tension is not truly a bet on abundance or irrelevance. It is a bet on time. It is a wager that the collective awakening will be postponed. That belief will outlast inventory. That convenience will defeat caution. Betting against silver is rarely about confidence and suppression forever. It is about confidence that the reckoning will arrive later, not now. History repeatedly confirms this pattern. Monetary assets that are suppressed through paper mechanisms do not fail gradually. They persist in a state of apparent calm until belief erodes suddenly. Before the break, prices often appear stable, even boring. That stability is misread as control. In reality, it is tension being absorbed silently. The longer it lasts, the more violent the resolution. Silver occupies a unique psychological position because it sits between worlds. It is too small to be ignored and too symbolic to be treated like any other commodity. It carries industrial utility, but also monetary memory. It reminds markets that value once required weight and effort, not keystrokes. That memory makes it uncomfortable for systems built on abstraction. Paper dominance relies on repetition. Every successful rollover, every settled contract, every unchallenged discrepancy between claims and ounces reinforces the idea that nothing is wrong. Over time, this repetition becomes normalized. Participants stop asking what would happen if everyone acted differently. The question itself begins to feel irrelevant. That is when the system appears strongest, and is in fact most vulnerable. A bet against silver in such an environment is an exercise in psychological game theory. It assumes that most players will continue to behave as they always have, that they will prioritize short-term liquidity over long-term certainty, that they will trust mechanisms because they always have, not because they have verified them. This is often a rational assumption, until it is not. Awakenings in markets are rarely ideological. They are triggered by stress, a delayed shipment, a regulatory change, a geopolitical shock, a loss of trust in an adjacent asset. When stress enters the system, behavior changes first at the margins. A few participants request delivery. A few more decide to convert exposure into possession. At first, nothing seems to happen. Then suddenly, everything does. Permanent control is an illusion because it assumes static human behavior. It assumes that incentives never change and fear never concentrates. But fear is contagious. Once a critical mass realizes that paper promises depend on collective restraint, restraint evaporates. At that point, paper dominance collapses not because of malice or conspiracy, but because belief can no longer be maintained. Silver does not need universal demand to break the system. It needs only enough demand to expose mismatch. A small percentage of participants choosing metal over settlement is sufficient to overwhelm structures built on fractional availability. This asymmetry is what makes silver dangerous to suppress and tempting to bet against. Those who bet against it are often correct until they are catastrophically wrong. They profit from inertia. They harvest complacency. But their success depends entirely on the continuation of a psychological state they do not control. When awakening arrives, it does not negotiate. It does not respect positions or timing models. It simply forces reality back into the equation. In the end, silver is less a market than a mirror. It reflects how much trust remains in promises detached from substance. As long as belief holds, paper dominates. When belief fractures, metal reasserts itself. Every major bet against silver is therefore not a declaration of victory over scarcity, but a quiet confession of faith that the collective will continue to sleep just a little longer. The Chinese billionaire's position is not rooted in ignorance or dismissal of silver's role in the global system. It is rooted in precision. It reflects an understanding that markets are not governed by truth in real time, but by structure, incentives, and timing. Silver's importance is not in question. What is being tested is whether the Western market framework can continue to contain that importance behind a stable price long enough for leveraged strategies to succeed. Western financial markets are designed to prioritize continuity. Stability is treated as a virtue, often above accuracy. Price is managed not as a reflection of immediate physical conditions, but as a signal engineered to preserve confidence. This creates a persistent gap between what is visible and what is real. Screens show balance. Vaults tell a different story. The billionaire's bet lives in that gap. Visible price stability is persuasive because it is repetitive. Day after day, silver trades within ranges that suggest control, liquidity, and depth. This conditions participants to believe that stress is either exaggerated or already resolved. In reality, stability often masks strain. When a system absorbs pressure without release, it does not eliminate it, it concentrates it. Invisible physical stress is difficult to measure precisely, which is why it is so easily dismissed. Inventory figures are delayed, opaque, and often reported in aggregate forms that obscure movement. Leasing arrangements blur ownership. Substitution mechanisms convert absence into accounting entries. To the untrained eye, nothing appears wrong. To someone who understands structure, these are signs of a system stretching its definitions to avoid admitting scarcity. The billionaire's position exploits this asymmetry of perception. He knows that most participants trade the price they see, not the conditions that support it. He understands that the market can remain orderly even as underlying stress increases, because order is enforced through leverage and rules, not through abundance. As long as contracts can be rolled and settlement can be deferred, the illusion holds. Timing is the critical variable. Truth in markets is rarely denied forever, but it is frequently delayed. Those who profit from leverage do not need to be right in the long run. They need to be solvent in the short run. Survival in leveraged systems depends on entering before the crowd and exiting before structure gives way. The billionaire is not claiming that silver will remain suppressed indefinitely. He's asserting that it can remain suppressed long enough. This distinction is essential. Many observers misinterpret such positions as ideological statements when they are in fact tactical. Betting against silver at a moment of rising tension is not a rejection of its strategic value. It is a wager that recognition of that value will be postponed by institutional inertia, regulatory caution, and the human tendency to trust what appears stable. Western markets are particularly vulnerable to this kind of test because they are deeply financialized. Layers of derivatives, funds, and synthetic exposure separate participants from physical reality. This distance reduces urgency. When ownership is abstract, concern is abstract. Physical stress can intensify without triggering immediate behavioral change because most actors are insulated from it. The billionaire understands that stress alone does not break systems. Stress must intersect with loss of confidence. As long as confidence remains, mechanisms designed to smooth volatility will continue to function. Margin calls, position limits, and liquidity injections can suppress symptoms even as causes worsen. This creates a window where contrarian leverage can be deployed profitably. But the window is not infinite. Leveraged systems are efficient but fragile. They operate like tension structures, stable under predictable loads, but prone to sudden failure when thresholds are crossed. The exact moment of failure is difficult to forecast, which is why timing dominates truth. Being correct too early is indistinguishable from being wrong. The billionaire's bet is therefore a stress test of Western resolve. It asks whether regulators will prioritize market continuity over price discovery, whether exchanges will adjust rules to preserve order, whether political actors will tolerate distortion in strategic materials to avoid admitting vulnerability. Each affirmative answer extends the trade. This is not without risk. When physical stress finally becomes visible, it does so abruptly. Delays turn into shortages. Discounts turn into premiums. What was invisible becomes undeniable. At that point, leverage reverses from advantage to liability. Timing ceases to be a tool and becomes a trap. The brilliance and danger of the position lie in its narrow margin for error. It relies on precise assessment of not just inventory, but psychology. It assumes that participants will continue to accept substitutes, that they will trust settlement over possession, that visible stability will outweigh invisible stress in their decision-making. In leveraged systems, truth does not reward patience, it punishes it. Those who wait for confirmation often arrive when exits are crowded. The billionaire's strategy is built around this reality. He is not challenging silver's importance. He is challenging the market's willingness to acknowledge it on schedule. When that willingness changes, the structure will reprice violently. Until then, the gap between price and stress remains exploitable. The bet is not against silver. It is against the moment when Western markets decide that the cost of maintaining the illusion is greater than the cost of letting it break. Trump's resistance is not driven by charts, indicators, or the language of speculation. It is driven by a worldview that treats markets as extensions of power rather than neutral mechanisms of exchange. In that framework, silver is not merely a traded asset, but a strategic fault line, a place where monetary trust, industrial security, and political authority intersect. Suppression, therefore, is not an efficient market outcome. It is a vulnerability. From this perspective, price action is secondary. And what matters is who controls the conditions under which price is formed. A market that allows a strategic material to be priced primarily through leveraged promises rather than physical stewardship is not free. It is exposed. Trump's resistance emerges from a belief that such exposure weakens sovereignty because it hands influence over real resources to abstract systems that can be stressed, gamed, or weaponized by external actors. Silver occupies a unique position in this analysis. It is embedded deeply in modern industry, from energy infrastructure to advanced electronics, yet it carries the historical imprint of money. That dual nature makes it sensitive to both supply chain disruption and monetary distrust. And when a material touches both domains, its price becomes more than a signal. It becomes a pressure point. Trump's political instinct has always been to collapse abstraction into tangible control. Tariffs, border policies, and industrial reshoring all stem from a rejection of invisible dependencies. In the case of silver, suppression through paper markets represents exactly such a dependency. It allows domestic industrial needs to rely on a pricing structure that assumes uninterrupted global trust and frictionless settlement. From a sovereignty-first perspective, that assumption is reckless. The issue is not whether silver should trade higher or lower in the short term. The issue is whether a nation should allow a strategically important input to be governed by mechanisms that prioritize liquidity over availability. When price is detached from physical constraint, it sends distorted signals. Producers underinvest. Refining capacity stagnates. Strategic reserves are neglected. The apparent efficiency masks a hollowing out of resilience. In this framework, suppression is not neutral. It actively discourages domestic strength. Artificially subdued prices reward financial intermediaries while penalizing miners, processors, and long-term planners. Over time, this erodes industrial security. A nation that cannot reliably source critical materials without appealing to fragile global markets is a nation that has outsourced part of its autonomy. Trump's resistance reframes this dynamic as political rather than financial. Silver is treated not as a speculative playground, but as an input into national capability. Once viewed that way, the tolerance for distortion diminishes. What might be acceptable volatility in a purely financial asset becomes unacceptable fragility in a strategic one. Monetary trust is the second axis of concern. Silver's historical role as money makes its suppression symbolically dangerous. When citizens observe that tangible stores of value are managed through opaque systems that appear disconnected from reality, trust erodes. This erosion does not remain confined to metals markets. It spreads to institutions, currencies, and governance itself. Trump's rhetoric has consistently tapped into this undercurrent of distrust, positioning tangible assets and visible production as antidotes to elite abstraction. Political power enters at the point where policy can no longer pretend neutrality. A government that allows strategic materials to be mispriced through structural suppression is making a choice, whether it admits it or not. It is choosing financial continuity over physical security. Trump's resistance challenges that choice, arguing that the cost of maintaining the illusion of stability exceeds the cost of confronting distortion. This is why the response is confrontational rather than technical. Instead of incremental reform, the impulse is to force recognition. Investigations, regulatory pressure, and rhetorical escalation serve to reassert authority over systems that have drifted into self-justification. The goal is not to fine-tune price discovery, but to reclaim it. In this light, silver becomes a line in the sand. If suppression continues, it signals that markets, not states, determine access to strategic value. If suppression is challenged, it signals a reassertion of political primacy over financial engineering. Trump's resistance is rooted in the belief that the latter is necessary for national survival in an increasingly competitive world. The danger he identifies is not that silver is cheap or expensive, but that its true role is obscured. When strategic materials are treated as mere entries on a screen, their loss is not felt until it is too late. By then, rebuilding capacity is slow and costly. Vulnerability has already been exposed. Seen this way, suppression itself becomes the threat. It delays adaptation. It encourages complacency. It creates a false sense of security that collapses under stress. Trump's resistance seeks to remove that false comfort, even at the cost of disruption. In his calculus, disruption now is preferable to dependency later. Silver, therefore, is not the objective. It is the signal, a test of whether a nation governs its resources through conscious strategy or allows them to be shaped by systems that optimize for leverage rather than longevity. Trump's fight is not with a market price. It is with the idea that such prices can remain detached from power without consequence.